Okay, I'm going to try to prepare a quick video here on debits and credits. I've noticed that this is one of the biggest sources of confusion for my students. I did this really quick and improvised um, this video right now, so I may stumble here and there, but I just want to go ahead and try to give the best explanation very, very quickly, okay? One of the biggest confusions that students have is that they think of debits and credits as debits may be a good thing, like sort of cash flows coming in or money coming in, and credits being a bad thing, or vice versa. And that is the worst way to start thinking, because that's what's going to create confusions. There's no such thing as debits being good, credits being bad. In fact, the words debits and credits are totally meaningless. We could use any word. We could use black and blue, to describe debits and credits. We can use whatever word you want, one and two, whatever word you want, you can use. So forget about the meaning of debits and credits. The meaning per se doesn't matter. What matters is how they relate to this equation that you see here. And this equation that you see here, many of you might recognize as the accounting equation. It's an incredibly simple equation, and it has nothing to do with accounting per se, but with common sense, okay? So if you can't understand this equation here, then it's going to be hard for me to help you, okay? So, because it's just pure common sense, okay? So for example, this is what this equation here says. Assets is one side, right? Let's do a little divider here. Oops, I'm trying to get this divided. Okay. It's a little bit too dark. I want you to see the equal sign at the same time. Okay? So now this is divided into two sections, right? It says assets. Anything the company has that helps it produce revenue. Anything. So what are things the companies can have that'll help it produce revenue? Cash, equipment, right? Buildings, land. I hear my little son coming to interrupt me. This is what happens when you do things in an improvised manner. Give me a second. I'm going to have to pause this. Okay, we're back. He wanted my phone. Anyways, yep, my 4-year-old son wanted my phone. He wants to play some games on it. Anyways, what are other assets, right? Accounts receivable is an asset. Inventory, right? These are a bunch of assets, right? And these assets have value, right? They have a value, okay? Now, that value, for example, let's say I have a total of, and I'm going to use very small numbers to make the example easy, $100,000 in total value of all these assets, okay? All these are worth $100,000. Well, that value doesn't all belong to the shareholders, the owners, okay? Think about a house, okay? If I have a house, okay, let me put this down here. Let me use the house as an example. Okay, house. House would be an asset, right? Sort of like buildings. And the house has a value of $500,000. Okay? And I put $200,000 of my own money, and I get a mortgage of $300,000 to buy it. Okay? How is it represented in this side? Well, equity is the portion that I own. I put $200,000. 1, 2, 3. Own with an N at the end. Not O, but own. I know the word sounds familiar, so I have to make sure I enunciate correctly. Okay? And my liabilities is going to be the mortgage, right? Hence, liabilities represent the portion of the value that I have in assets that I owe to others, and equity therefore must represent the portion that belongs to me. Therefore, this is a very simple equation, right? Very simple equation. The total value that you have in assets either belongs to you or you owe it to somebody else. There's no other way around it, okay? So if you don't understand this equation here, you need to pause the video and you need to think about it, and you need to go and find somebody to help you explain this, because this is not very difficult to understand. I don't want to sound mean here, but at this point, this is a very simple concept, okay? Everything that a company owns, the value, either belongs to you, that portion of the value, or you owe that value to somebody else. I bought a house. The house cost $500,000. Yes, you say, oh, I own this house. Well, you don't really own the house. Stop paying your mortgage, and you see how quickly the bank is going to take it away from you, right? You own $200,000 worth of that house, and the rest is owed to the bank, okay? It's important to convey this information to investors, right? Because the value that the shareholders truly own is this portion, right? So of a company, you want to show them the total value and assets that the company has, how much is owed to the others, and the remainder then belongs to the shareholders, right? And this is the value that the shareholders have, and the shareholders' goal is to increase that value, right? Just like your goal is to increase the equity that you own in your house until if everything goes perfect, you will have zero owed to the bank once you pay off your mortgage, and you will have the full equity belonging to you, right? So notice how this equation always stands, okay? You have to understand this equation because this is the basis of accounting and the basis of debits and credits, okay? So, let's go back to the example. Same thing. Everything that a company owns, okay? That they're going to use to create revenues, right, and expenses to create profits, either belongs to them or to somebody else. So the way to look at it is, if I have $500,000 in total assets, then I owe to the bank $300,000, then my equity is $200,000, okay? So with that in mind, let's go back to debits and credits. Somebody by the name of Luca Pacioli saw this formula here and said, oh, this formula is quite neat. Why don't we come up with a system where we go ahead and we book transactions in a manner which follows this formula where it always balances out, okay? And so let's create two sides, right? Notice how this side here may represent this side and this side may represent this side, okay? Let's just think about it right now. And these sides must balance, right? You know that they have to balance, okay? If I were to put this number here, this would be 500,000, right? This would be two numbers, 300,000 and 200,000. Okay? So you see that, right? Okay. So let me just make up some other numbers here, just to make my life easier. Instead of having, in fact, I will. Well, let me not complicate things. Okay, so so Luca Pacioli said, okay, this is almost random. He said, okay, let's make the assets go up with debits. Okay? Let me delete this now. Now that you have that concept, let me go ahead and let me just keep this for now. Let's just create a system where the assets go up with debits. Okay? Now think about this. If both of these sides must balance, okay? And I start you off by telling you the assets must go up with debits, right? Don't try to find some logic to it. There's no logic. It's just a given information. It's random, okay? Okay, I'm going to start a system where the assets start with debit. Okay, that part is random, but the next part isn't random. If debits must always equal credits, and this formula, you notice this line here, is linked to here, right? I can take this, and I can do something like this. Well, I can't do it. I could do this. Okay, let's do a little line here so you can see. Okay, that's that formula. So Luca Pacioli just decided, okay, every transaction, it has to affect one of these two sides. And if I go ahead and create a system where I represent how that transaction affects either of these two sides by doing what we know today as a journal entry, then I could create a very good accounting system. Okay? So, like I say, I have to start you off because the first thing is not logical. It's just given. Okay, so I'll start you off by saying, okay, let's start a system where assets go up with debits. Okay? Now you should be able to figure out the rest. If assets go up with debits and they're on this side, then liabilities and equities, which are on the other side, must go up with, you got it, credits, right? Again, notice how there's no logic to this. This is just, there's a logic to it as far as the formula goes here. But I have to start you off with this, okay? Now let's take a look at the other two general categories that you put entries into. Revenues is the money that you are going to make that, and the revenues are going to increase your equity, right? And your expenses are going to decrease your equity. So think about it this way. If revenues increase your equity and equity goes up with credits, then revenues are also going to go up with credits because eventually you're going to move this, you're going to shift this over to the equity side. So when you close your income statement, so you must book the entries into these categories on the same side of the equity, right? Revenues and expenses, the net effect of this is tied to equity. Okay, net income is closed into equity, the account called retained earnings. So revenues are going to go up with credits, and expenses are going to go up with debits because debits will decrease credits, equity, sorry. Okay, because notice one thing which I haven't said yet. I'm giving you the side that increases these categories. So if assets go up with debits, assets go down with credits. If liabilities go up with credits, liabilities go down with debits. If equity goes up with credits, I'm not sure, did I said this right? If liabilities go up with credits, then they go down with debits, okay? If equity goes up with credits, it goes down with a debit, right? Notice how my expense will eventually bring my equity down. Therefore, I'm going to book a debit on my expense account so that when I shift it, when I close this account and move it here, it's going to fall on the debit side. I'll show you that later on, okay? That's the whole basis of accounting debits and credits. Once you know this, that's the explanation, okay? Don't try it. I cannot give you a definition of debits and a definition of credits that's going to clear things up without giving you this whole explanation of the accounting equation, assets, liabilities, equity, revenues, and expenses, because you're not going to understand it. Because debits and credits don't have a meaning on their own. Debits and credits only have a meaning as they relates to asset, liabilities, and equity after understanding the relationship between assets, liabilities, and equity, right? So the relationship is assets equals liabilities plus equity. We already know that. I explained it, right? Everything a company has, the total value, if you owe a portion to it, then the remainder belongs to the shareholders' equity. A house has a value of $500,000. If I owe $300,000 to the mortgage, then my equity is going to be $200,000. Businesses are the same way. Everything they have, cash, equipment, land, property, equipment, a portion of that value is owed to creditors, okay? The remainder belongs to the shareholders, the equity side, okay? So if you don't believe me, let's take a look. I'm a brand new company puts money in. Shareholders put money in, right? From the beginning, okay? What two things went up in this equation? Let's say $100. Well, if the shareholder put the money in themselves, I'm the owner, then cash went up, right? Cash, that's my asset. I put cash in. I'm using very small numbers, okay? Cash went up on that side. Who does that cash belong to? It belongs to me because I put it. I'm the shareholder. I'm the owner. All that cash belongs to me. So that equation stays in balance, right? That's what we have in the equation. 100 in cash, and that belongs to the shareholder. How would I book that in a journal entry? Well, I would simply go cash. This is my debit side. And then I would go equity. Paid in capital. Let's call that paid in capital is an equity account. It means that this is the money that the owner put in. Okay? Paid in capital. Okay? So this is how I book that entry. Okay? More importantly, what I want you to understand is why we're using debits and credits, okay? Why? You know, if I show you this and I didn't give you the prior explanation, you would say, but why? I don't understand this, right? Well, now you understand. Because cash is an asset, and both of these sides must always stay in balance, right? And that cash belongs to the owners, and it's in equity, so we put it on the credit side. Okay? Let's do another one. Okay? Let's say I borrow $200 from a bank. Think about it. What asset went up? Again, cash went up because I borrowed $200. Does that belong to me or do I owe that $200? That belongs to the bank, right? Not really my money. I'm not $200 richer just because I got cash. I owe it to the bank, okay? So how do I represent that? Well, the entry to represent that would be cash of $200 that I got, and then I could put something that represents a liability, something like loan, okay? To make it very simple for those who are starting off in accounting. We could also use the word notes payable, right? So cash went up. Notice how this stays in balance. That stays in perfect balance. So that's how debits and credits work, okay? Let's say I buy equipment. Okay? Equipment is an asset. Let's say I buy $150 worth of equipment using cash. Using cash. Okay? What did that affect? It affected only this side, right? $150 in value came in of equipment, but I used $150 in cash. So I have a negative there. Sorry. So it doesn't always have to go on both sides of the equation. Notice how we hit only one side of the equation. However, the equation stays in balance, right? Notice how I told you if assets go up with debits, they go down with credits. So how do I represent that in a journal entry? Well, my equipment is an asset. I'm going to bring it up with a debit. And my cash is an asset which went down. I'll bring it down with a credit. And that's how. Again, the equation is always going to stay in balance no matter how complicated accounting gets. This is a very simple transactions, right? No matter how complicated it gets, this is how it's going to work. Okay, let's take a look at revenues and expenses. Okay. Okay. I'm going to erase this for now. Let's bring this down a little lower. Let's say I pay my employees for work that they did, $50, right? And it goes to my employees. It leaves the company, okay? It's not even in the company anymore. So when value leaves the company, when I use an asset and it leaves, the value exits the company, it's an expense, right? So my cash went down, right? $50. Cash is an asset. Cash goes down with a credit. Okay? And how do I recognize that exit of value? That's an expense, right? You need to understand that. Wage expense is 50. Notice how expenses go up with debits. Okay, so we're going to put it here temporarily. Okay? Notice that if you only take a look at this section here, we are temporarily out of balance. Don't worry, we're going to fix that in a second. Okay? And I'll show you how. Let's say, because of the work that these employees did, so if I exclude the effects of revenues and expenses, you can say that we're temporarily off balance, right? If I include the effect, then we're not. Okay? My cash went down. And so far, I haven't captured the effect of that cash over here. Okay? I'm going to show you what happens later on. Okay? But this work helped me create revenues of $50. Okay? So I paid my employees $50 for work they did at somebody's house, and that customer paid me, the company, $75. Okay? Well, now I got $75 in cash. And that's called revenues. Notice how revenues go up with credits. Okay? And I'm going to explain this a little bit better later on. Okay? So my cash went up. So cash went up. So I'm slightly off here, right? I have this here balances with this, and these two don't have counterparts here yet when we only look at this formula because they're sitting in the income statement, okay? But this income statement now accounts are going to be shifted over to here, to the equity side, when you close your income statement books. And if you don't understand that, you're going to have to go to the closing process. Here I'm focusing more on explaining debits and credits, okay? So, how do I close this? Where do you close your revenues and expenses? You close them into equity, into the retained earnings account, okay? That's where you close them, okay? So, let me show you some T accounts here to show you what I'm going to do. A T account represents each of these individual accounts, right? So the first one that I did was wage, which, by the way, in the T account, let me just, the left side represents debits and the right side represents credits, okay? And so let's go ahead and copy this here and copy this here, okay? And let's say this account represents wages expense. And this account here represents revenues. Okay. Okay, and let's create one that represents, okay, well, anyways, so when you did this entry, you did a debit to the wage expense account, right? And you did a credit to the cash account, and you would have a T account for cash where it would have a credit. I'm not going to show that part, right? And when you did this entry, you would have, this would affect your revenues over here with a credit, and then your cash would get a debit, okay? You would have, let me do the, I could do the cash. Let me do it over here. It's just that I'm running out of space, but I could put it over here, right? Let's do cash, okay? Cash. So over here, when I did the $50 in expense, I did a $50 credit in cash, right? You notice that entry here? Let me make it color coordinated to make it nice for you to see. Put it this color, or make it a color that you can see better. Okay, so this is this and this, okay? This is the journal entry. This is the ledger representing that keeps track of each individual account, right? And then you have this one here. Let's give it another color. We could give it this color. And you have cash of 75 here, which was the debit, and the revenue got a credit, okay? Now we're going to notice how this affected the asset side. We have to show how that transaction affected this side over here. It's temporarily stuck in the income statement. This is the balance sheet accounts. These are the balance sheet accounts. These are the balance sheet categories, I should say. And these are the income statement categories. So they're stuck in the income statement, and we want to show the effect here. Well, if your company lost $50, if value of $50 left your company because you paid your employees, but $75 came in, that's a net positive value of how much? 25, right? So your income statement is going to show profits of 25. That $25 of profits, does that belong to the creditors or does that belong to the shareholders? Your answer should be to the shareholders, right? So we want to transfer, we want to show that effect here. The way we show it is by transferring the effect of the income statement to the balance sheet, to the equity account called retained earnings. Okay? So that's not difficult at all. One entry, let's make some space here so that you can see this better. I'm almost running out of space. Okay, so let's transfer the effect of these two accounts. Also, another thing to remember is that the income statement is for 1 year, so you have to close it out to start the next year. So let's close my income statement and transfer the effect over here to retained earnings. And as you can see, I am indeed running out of space. Let's see if I do this. Maybe if I do this, perfect. Get a little bit more space here. Okay. So I'm going to hit the retained earnings account here, and my net effect on equity is 25. So I'm trying to get 25 over here, right? And that 25 here is going to offset the effects of these two. If I put 25 here, let's go ahead and merge this. You will see that this 25 captures the effect here, and that both sides are going to be in balance. And if you don't believe me, pause the recorder and count and sum it up, and you will see. So what we do is we close it into retained earnings. To close the wages expense account, it has a debit balance. I must put a credit, right? I must do a credit of 50, right? This is the closing entry. So let me give it another color. Now I put a credit there, and I'm going to transfer it over to retained earnings with a debit. Okay. And then I want to also close the revenue account. So I need to close the revenue with it has a credit on it. So I'm going to put a debit to revenue to close it, right? Let's give this a different color. What color could I give it? Let's give it this little boring color here. That's too boring. Let's give it a nicer, less boring color. Okay. And so revenues is going to get, notice how these sides have the same number. So the net value on this is 0. You've zeroed out your income statement to start the new year, and you've transferred the effect over to the equity side, right? So retained earnings here is going to get a credit. Okay? And so retained earnings gets the credit here. Okay, so in this process, which is known as the closing process, you've closed your income statement account, and the net effect, the net balance in your retained earnings is 25. Well, guess what? That goes down here. That's the 25 that you've shifted over from here to here. Now the equation is in balance again, okay? But the main point here wasn't to show the closing process. The main point here was to try to give a very basic explanation of why the accounts go up with debits and credits, and why we use debits and credits on each account, and why, as you know, because it's very hard to understand, you know, the reasoning. Debits and credits have no true meaning behind them. In order to understand debits and credits, you must relate them to assets, liabilities, equity, revenues, or expenses. You must understand the simple accounting equation that says assets equals liabilities plus equity, and how Luca Pacioli created a system, the double entry system, where the debit side will always equal the credit side, right? Each transaction is captured with a journal entry, and both sides are always going to match. And so that's why assets go up with debits. Why? That's random. That was given. Okay, somebody he decided, okay, assets are going to go up with debits. But once he decided that, based on this equation, then liabilities and equity must go up with credits under his system, right? Revenues must go up with credits. I explained that why, because this is eventually going to go into equity, and revenues bring equity up, therefore we must credit it. We must use the same side, and expenses eventually move into equity, the effect of expenses, and equity goes down with debits. Since expenses bring the equity down, we book expenses on the debit side. Okay, that's my summary. If you didn't understand it, view the video again and again and again and read more. But this is the most basic explanation that I can provide right now. Remember, don't try to define debit in one particular way or credit, okay? Don't think about, oh, well, I go to a bank and they credit my account, so no. Don't think about that way, okay? None of them are good or bad. If you notice here, a debit increases your assets, which is good. A credit increases your equity, which is good, okay? A debit increases your assets, which is good. A debit increases your expenses, which is bad. So you can't really define debits and credits with one single definition. The only way to understand debits and credits is to relate them to this accounting equation and the 5 general categories where we're going to do entries into, okay? I hope this video was helpful. Thank you.